Hello, my name's Kurt. I'm a value investor, and today we're going to look at Chegg stock. We're going to do a stock analysis in discounted cash flow valuation and find out if it's something I want to invest in right now. If you want to follow along for more stock analysis videos, hit the subscribe button so you can stay tuned. And if you like this video, if it provides you any value, hit the like button. I really appreciate it. So let's get into the presentation. Before we start, I want to point out that the financial data that this covers is through quarter 3 of 2023, and so that's September 30th for Chegg. So let's look at real quickly the steps of valuation before I get to Chegg specifically, so we're all on the same page. Like, the first thing I would do is I project the future free cash flow of the company using some conservative assumptions if I'm doing it right, and I'm checking with guidance and estimates there to make sure I'm not going crazy. And then I discount that future free cash flow to a present value, today's present value, using discount rates that I find appropriate for investing. Then we have to adjust for the expected share count. So do we think that the company is going to issue more shares and dilute current shareholders, or do we think they're going to buy back shares? And how are their shares going to, how much are they going to reduce or increase by? That impacts our investment. We also, third, assess the balance sheet, and we take their assets, their debts, and we subtract the debts from the assets. We do some adjustments and come up with a booked value that today we would buy their balance sheet for. So what's the value of their assets that they have? So as we're buying into this company, we're taking ownership of that too. So what's the value of their balance sheet and then their future free cash flow there. So number 4 is just to check the pillars, like the fundamentals of the business, to make sure the company's healthy, it's predictable. So as we're predicting future free cash flow, is anything really bad going to happen or likely to happen? Or is this a steady company that's proven that they have good financial results over time? So those fundamentals we'll check at the end. And by then we should have a good understanding of, like, it's undervalued and it's something that is a company that's very steady that we want to invest in, or is something off there. So Chegg, if you haven't heard of Chegg before, they are a company that helps college students mostly. They provide assistance to, like, study tools, textbooks, solutions to problems, and examples of how to work through problems. So they have these tools that students subscribe to their service, and they have access to those tools. And depending on what classes they're in, they can get help, because you go to a lecture in college, you hear the lecture, but then it's time to do the homework, and the lecture doesn't always help you to know everything there that you need to. So you have to do a lot of studying on the side, and Chegg helps students do that. And they have new tools like AI tools of how to answer certain questions and things like that. And some people probably think that AI might really attack Chegg's business, because now students, instead of using a service like Chegg and paying for it, will go to free AI tools and say, hey, what's the answer to this problem? And just write down what they have. So we can think about that, but I'm not going to delve too much into that. You can put your thoughts in the comments if you think AI will really kill Chegg, or maybe Chegg will use some AI tools to make their service better and more attractive to their consumers. Their market cap is $1.8 billion, and they have about a 7 price to free cash flow ratio. Their price to earnings right now is negative, or it's on the verge of being negative, because they have really fluctuant net income. We'll talk about that in a second. Now, their guidance at the beginning of this year said that they would have $190 million of free cash flow by 2023, and that would represent a 30% year-over-year increase, but they've since reduced that quite a bit, representing about a 10% year-over-year increase. There's not a ton of guidance and estimates out there, but most analysts are pretty pessimistic on Chegg right now. They have, like, very moderate growth in the low single digits to high single digits. Chegg's internal guidance there representing something between like 10 and 20% guidance into the future for growth. So let's take a look at what's been happening in the past few years. We can see the price history of their stock here, and we can see that it was above $100 per share, over $110 per share at its all-time high back in 2021. There's a lot that was happening there. Like, before COVID, learning was one thing, going to college was one thing, but then during COVID, things got really disrupted in the college space. So you can see where a lot of liquidity in the economy helped the price to go up, but also when interest rates started going up and the college learning was disrupted in some way, some major ways, then the price really crashed down, and it was up above $110 a share, now down around $10 per share. So the 90% sell-off. That provides an opportunity to us to say, okay, wait, what's really going on here? And if this stock bounces to anything close to what it was before COVID, it was above $40 a share back then. If it gets anywhere close to that, we could be in a position where we can make really high returns. So let's look at their financials. Here's their revenue. You can see over the past 10 years, it's grown steadily, but it's gone a little cyclical in the last few quarters. It's been declining slightly. It's done that before, actually, back between 2015 and 2017. Their revenue also declined, and then it picked back up before COVID and really took off during COVID. So their revenue is a little bit interesting because it's not the most steady, but at the end of the day, 3-year, 5-year, 10-year annualized growth of 14%, 24%, and 15%. Now, their net income is a slightly different story. They've had very fluctuant net income in the last few quarters, in the last couple of years. They were losing money for a long time. The $0 is actually the second bar on this chart. So they were making negative profits for a long time. And then during COVID, their profits really spiked way up, and then it's come crashing back down on a 12-month rolling average since then. So we can't learn a lot from their net income. Now, if we look at their free cash flow, we see that their free cash flow is a lot more steady and positive. So what's happening there? Why is their free cash flow saying one thing, but their net income another? Well, obviously that's coming from some accounting things there where they're having write-downs on previous investments. So they're showing losses there, but their free cash flow, which is their cash from operations minus capital expenditures, was positive that whole time. So we like to look at free cash flow predominantly. And if there's a big discrepancy, we want to answer the questions why that is. But I don't have time to get to that in this video. Just to show you their free cash flow here, okay, they're positive. It's growing a lot. Now, in the last few quarters, again, it's declined. It's sort of correcting back to that pre-COVID trend. Because it went up pretty fast there. So a slight decline here doesn't worry me too much. The 3-year, 5-year, 9-year growth annualized is over 30% for the 3-year, 5-year, and 19% over the last 9 years per year compound annual growth. That's pretty high. That's pretty good. So, okay, let's look at their shares outstanding. We see that for a long time when they were showing negative profits, they were diluting shareholders by issuing new shares, and their stock price was really increasing during this time. And right when they hit their all-time high in their stock price was when they had the most shares, and when the stock price crashed, they started buying shares back with that free cash flow that they had, which I think is a really interesting and probably a good idea by their management, because the stock price now is so low and they have an opportunity to buy back shares to make a real difference for their shareholders. Okay, so they're really reducing. In the last year, they've reduced 22% of their shares outstanding. And you can see that, okay, maybe that trend won't continue forever, but you see the real phase of a business here. As it matures and starts to become profitable, it starts buying back shares. But up until that point, when it's not profitable, it issues shares. So that's the life cycle of a company. So maybe Chegg is entering that mature phase, and it's a very powerful trend of buying back shares here. Their balance sheet shows that they have $260 million of cash on hand, which I really, really like, especially given the fact that their debts are $150 million in the next year and long-term debts of $600 million. I mean, they have cash to really cover that. And they have nothing showing in inventory, which is awesome. Their property, plant, and equipment is pretty small relative to their total assets of $1.8 billion, with total liabilities of $800 million. So I've adjusted their book value, taking some things into account. I show right there in the bullet points, and I have an estimated book value of $663 million at a price per share of $5.73. So we're going to add that back into their value after we have the present value of all their future free cash flow. One last look here at their business pillars. You can see that they check 6 out of 8. I did some manual corrections here because they don't have a full 10-year history on some of these metrics. So the problem there is with their return on invested capital. To me, And of course, their net income is not so stable, so the price to earnings ratio is a little off there. I really want to see them continue to put out positive free cash flow, growing revenue, growing net income. It's right on the fence there between, hey, it's somewhat fundamentally sound, but there's question marks there that I think need to get answered with time for it to really be one of those businesses that you go, yeah, this is growing long term, and it's really fundamentally sound. So I'd say okay, but not superb. So let's get to the valuation. This is what we've been waiting for. My assumptions are shown there: 13%, 9%, and 1% in growth and free cash flow. The 13% near term, 9% long term, and 1% terminal. You can put in your own assumptions and do your own calculation for the valuation. These are my assumptions. Do I know they're going to grow 13% over the next 5 years? No, but they've grown at 19% over the last 9 years, and they have estimates to grow at 10 to 30% themselves. That's their guidance. So they could be settling down right now for the next year or two, but then over 5 years, I trust in that long-term growth. This is a growing space. They're offering a service online. They have a very big brand. And although AI poses some concerns, I think they can leverage that technology to actually make their product even better and more competitive. So I have 13%, I have 9% long-term, which is over the next 20 years in annual growth. So based on the price today, and the assumptions that I have down there are shown, like we have a 70% safety factor, or a safety factor that reduces our estimates by 30%. And we have target returns of 10 to 20%, and the book value that I laid out earlier. So the expected return at the current price of around $10.50 a share is 27%, which is really high. But the problem with such a high expected return is if we tweak those assumptions to say, oh, they're not going to grow 13% near term, they're only going to grow 8% per year. And if we change that long term from 9% to 7%, it could really, really make a difference on the expected return. So if you believe in these assumptions, then you can expect a 27% return per year if you buy the stock at the current price. And the estimated fair value per share, if you're looking for that average of between 10 and 20% discount rates applied, is $22 a share, where they're currently sitting at around $10, $11 a share. So to me, that's a really, really good discount there to its fair value. So in summary, the fundamentals leave a little bit of question mark there because the company's maturing right now. So can they sustain some of those positive trends? And the ones I really want to look at is to get their earnings back positive and their return on invested capital. The fair value of $22 per share means that the stock is currently underpriced, and the current price gives a yield of 27% return. So that presents a real opportunity. But if you assume some other trouble with their future earnings and free cash flow, that could be in question. So really, really undervalued if you believe in a positive outlook on Chegg. So when you combine those assumptions that I've done with their price, their valuation, plus their fundamentals, I think overall it's a good opportunity because the fundamentals, remember, we have a question mark, but as they stand right now, they're not bad. The fundamentals are good. They're moving in the right direction, and they're pretty stable, especially when you look at their free cash flow. So I give them 4 out of 5 stars, an 8 out of 10 value investment rating. That's my rating. It's not professional advice. It's what I'm using to rank companies that I've evaluated, so I know whether to look at them or not. So if you agree with my assessment of Chegg, then please leave a comment down below to let me know, and bring up any other concerns you have about Chegg. What assumptions are you using on their free cash flow growth? And why are you using them? I love to hear that. So sometimes people say, hey, no, this company is terrible, or yeah, I think this company is even way better than you're projecting. So I want to know, what values are you using for their free cash flow growth? Like, what values are you plugging in there? Because without those numbers, we can kind of provide commentary and just talk back and forth, but it doesn't really mean anything in terms of their dollars per share, their fair value. So that's why I provide this type of presentation. If you like these videos, go ahead and subscribe so you can keep following along and keep learning valuation and value investing with me. and leave a like on the video again if you enjoyed it. I really appreciate all the support, guys. I'll see you on the next video I do, and if I don't see you before Christmas, have a Merry Christmas and a Happy New Year. Best of luck investing. See you next time.